TeamLease is on our radar. Motilal Oswal recently had a bullish view. The stock, they've upgraded the stock to a buy. They say that there is scope for re-rating as near-term challenges have eased. Ramani Dathi, who is the CFO at TeamLease, joins us now to discuss their business momentum and the outlook going forward. Ramani, thanks a lot for joining us on the show. Appreciate your thoughts here and good to see you in this morning. Motilal Oswal in the report talks about how the margins at 1.6% are now the bottom that the company has seen. And there is a good improvement from here on, given the kind of pickup we've seen in hiring as well as the cost optimization methods that you guys are undertaking. Just take us through what the margin trajectory could look like and what are the levers that you have in place?
Sure, Sonia. So in FY23, our main margin contributing businesses, which are our IT staffing business and degree apprenticeship business, both have had very strong headwinds. IT, we have seen globally, the entire hiring was on freeze and we lost some headcount as well in that segment. Same with degree apprenticeship, with the regulatory changes and uncertainty around the NEEM program, there also we lost some headcount. So that's the bottommost margin levels that we can hit to 1.6%, what we had last year. And with the initiatives that we have taken on cost optimization and with staffing business growing quarter on quarter very well, we are confident of improving margins consistently from here on, Q2 onwards. Especially if I take general staffing business, last quarter we did about 8,000 and we have a very strong outlook for FY24 as well. We are confident of doing close to 8 to 10,000 net addition quarter on quarter in general staffing business. And the growth is across segments and across industries. And that will be the main margin expansion contributor for us. In case if IT staffing get picked up, that can be a wind on our back. We can accelerate our margin expansion further.
So when you say improve your margins further, are you looking to get back to the 2% plus mark anytime soon in FY24 itself? Could it be much higher than that? If you can give us a ballpark range.
In FY24, I don't think it is possible until and unless there is a huge turnaround in IT staffing business, because in general staffing business, our gross margins are 3%, whereas in IT staffing, gross margins are almost 16%. So we need the IT staffing segment to pick up to get to a 2% overall net margin. So in FY24, I can't put down any number. We don't give guidance, but definitely there'll be a margin improvement from FY23.
Right. How is the first quarter, 2 months of the first quarter are behind us? How has the quarter been? I think you had mentioned that post Q2, things will improve substantially. So could you provide us with some numbers? Q1 first, how's Q1 so far been? Is it better?
Yes.
Already showing signs of improvement? And, what will happen after the second quarter?
Our main business segment, general staffing, is growing very well and better than last year. So first 2 months into the quarter, we had very good headcount addition, and we believe the same momentum can be continued. Because right now, except for the IT tech hiring, so we are seeing good amount of hiring happening across all other industries. So for us, the three main contributing segments in general staffing are banking and financial service, consumer verticals, and telecom. And we believe these three segments will continue to give us more numbers in the coming quarters as well. IT, as of now, the numbers are kind of stagnant, and first 2 quarters, we are not expecting any kind of revival based on the discussions that we are having with our clients. But we are hoping that from Q3 onwards, we can see some green shoots in IT staffing as well.
All right. Hi, good morning. The last time around when you joined us, you were telling us you're renegotiating some contracts to boost productivity per employee. Can you elaborate on that? I think, you were trying to give us some outlook with regard to that as well. So what are the contract renegotiations that you're looking at?
So we have been stuck at an average realization of 700 rupees per associate per month for a long time, Nigel. And this is something which has impacted our overall margins as well in the last year. So we have started renegotiating the contracts wherein we can pass on the inflation impact in our associate salaries back to the customers. But to be very honest, we are finding it extremely difficult. So what we are doing in the back end is we have taken digital initiatives to improve our core employee productivity. And because that can directly contribute to our margin expansion. So even though we are planning to add almost 8 to 10,000 new associates quarter on quarter, In the back end, we are not increasing any costs or any core employees to handle this scale and volume. So that should directly contribute to our margins. Again, I cannot put on a specific number because our margins are derived by the top line, which is a flow through of associate salaries. But definitely there'll be a margin improvement both in absolute as well as percentage terms.
Okay, a margin improvement in absolute as well as percentage terms. But can you tell us in terms of renegotiation of contracts, can you just quantify it for us? I think I missed that. How much will that help you boost your productivity per employee? And if you can just share some numbers with us on what the way forward could look like.
Yeah, Sonia, actually, I mean, both are two different elements. Renegotiation of contracts is to increase our average realization, our gross margin. Productivity is the one which is below the gross margin, where our core employee costs we are trying to optimize. So, for example, in case of IT staffing, post-COVID, there is almost a 20% inflation in salary costs of the associates. So we have gone back to the customers and increased the rate cards, renegotiated on some of the margins, and made sure that the gross margins have remained at that 16 to 18% range in IT staffing. In general staffing business, unfortunately, we are kind of stuck at that 700 rupee PAPM, while we have been continuously working on how to improve that, be it by way of renegotiation or by offering value-added services to the customer. We are finding it little challenging. I think even in FY24, for at least 1 or 2 quarters, we may continue at the same level of gross margin. But at net margin level, with the help of productivity enhancement, we'll expand margins.
We'll leave it there, Ramani. Thanks very much for your time. Good speaking with you. Good luck, and hope to, as you say, maybe a little down in the year, IT staffing perhaps will also start to improve. Thanks very much for joining us. And that's been a trend we've seen with companies like Info Edge, etc., as well, Naukri, where the IT business is under pressure, but some of the other segments are all firing and firing hard. That shows up in the markets as well, really.
Yeah.
Right? We just had Ajay talking about how, not Ajay, but Rana Gupta talking to us about how IT is the one which is the culprit. Otherwise, the index itself should have also done well. So that's a little bit of the hiding trends that we have
And
right
there's
now.
also a clear slowdown in technology staffing, right?
Yeah.
Specialized technology staffing. So that is something that's evident and perhaps having a repercussion on the IT sector.
Some excesses last couple of years getting pulled back, right? We'll take a quick break here. Ajay is with us, and so will Shrikant Chauhan join in for some technical trading ideas, and we'll have Kush Bora join in as well. Stay tuned. That conversation follows.